Hi, friends. If headlines were your only guide, it would be easy to believe that we've already peaked in this cycle and are now sliding into the downturn. From the recent all-time high of the S&P around 604 to the 505 close at the end of Liberation Day week, the market has dropped 16%, with more volatile assets losing as much as 50%. It's been a powerful reminder of just how quickly sentiment can shift and a perfect moment to share what I've been learning as I navigate my own positions through this volatility. The biggest realization for me, having the skills to actively manage my portfolio, whether markets are rising or falling, has created a sense of confidence and control I never had as a buy and hold investor. Now that I've proven to myself that I can apply strategies for any market condition, I no longer fear what might happen next. Instead, I can respond, adjust, and stay grounded even in uncertainty. Whether or not you believe in the current administration's economic experiments, tariffs, Bitcoin reserves, or stablecoins, it's clear they are pressing into new territory in an attempt to disrupt the cycle that brought us a $37 trillion national debt. Since the 2008 financial crisis, the expectation has been that the government will pressure the Fed to bail out the markets. But this time feels different. And with that difference comes increased uncertainty. So what can we do? Go to cash and wait. You might miss opportunities, but avoid ruin. Go all in on gold or Bitcoin if you're sure the dollar's in trouble and you won't need liquidity, or learn the skills that let you thrive in the uncertainty. I've chosen the third path because it's during uncertain times that wealth changes hands. If you wait on the sidelines, you might lose what you have or miss what could be gained. But if you lean in, learn, and practice, you position yourself to be on the right side of this wealth transfer. Let's look at what I've been doing and what I've learned this month. Options trading, the amazing value of a good hedge. In past newsletters, I shared how I was exploring both hedging and trading with options. Because time decay, theta, can eat away at trades meant to profit from price movement, I've shifted away from trades like butterflies and spreads and now focus more on directional moves, buying long when prices are low and shorting when prices are high. But before diving into options trading, back in June 2024, I put on a long put position to hedge against a major market drop. At the time, SPY was at 524, and I chose a strike near 400. Through the second half of 2024, as the markets reached new highs, that hedge dropped, first by small percentages, then by double digits. At the peak in February, when SPY hit 604, the hedge was down 90%, but it was insurance. I didn't panic. I held, and then came April. As tariffs hit and the markets fell, my long put hedge started recovering fast. By Thursday, it was back to break even. By Friday, it had gained 80% in just one day. Here's the key insight. That single position almost exactly offset the drop in all my other equity positions. My portfolio ended the week within $100 of where it had started. At times, it was even higher. I haven't closed the hedge yet. Volatility isn't over. If it doubles, I'll take off my original investment and let the rest ride. If the markets start recovering instead, I'll use the profits to invest in assets that saw the biggest drop. On the flip side, I had also entered a long call position a few weeks back, intending to hedge the hedge when the market seemed poised to rebound. That position dropped 90% during this current correction. It briefly went to zero before liquidity returned. I tried to increase my position, but the order didn't execute before Friday's close. I'll try again Monday. Lessons from these two. A small hedge, 4-digit investment, can protect a large 6-digit portfolio. Even with time decay, a far-dated put can survive and recover when volatility hits. Options don't need leverage to be powerful. Short-term calls used as hedges can fail if not actively managed. A well-placed put does more than protect. It brings peace of mind. That said, options aren't the only way to prepare for a downturn. Let's look at another strategy I've been testing, shorting the market, shorting the correction. Last newsletter, I shared that I was testing shorting strategies. At that time, I had opened two small short positions, one on Duke Energy, the other on gold. Both did well initially, but I let greed delay my exits. The market reversed before I took profits. Thankfully, I had moved my stop losses to break-even levels, so I avoided larger losses. Here's what happened next. My Duke Energy short was stopped out with a small 1 cent per share loss. I re-entered the trade, but doing so created a wash sale. My gold ETF short had multiple stop loss settings. When the asset gapped up, neither stop triggered. I had to exit manually at a much greater loss than expected. Understanding the wash sale rule. A wash sale happens when you close a position at a loss and re-enter a similar position within 30 days. The IRS disallows the original loss and adds it to your cost basis on the new position. It doesn't eliminate the loss, but delays the tax benefit. It complicates reporting and can cause a trigger for a tax audit. It can trip up active traders unintentionally. I inadvertently created wash sales on both Duke and gold. Then something unexpected happened. On the Duke trade, I expected the stock to fall. It had hit all-time highs, and utilities usually don't move this fast. Instead, it skyrocketed, triggering my wider stop. I lost again. Why? A new CEO took over on April 1st, and investor optimism spiked even as the overall markets were dropping. I had ignored fundamentals. Had I waited, I would have seen Duke drop from 126 to 119, exactly the move I was originally targeting. But because of the wash rule, I had to sit out. My combined losses on those Duke trades were $675, and the missed opportunity cost was about $1,800. Lesson learned, never skip your homework. The gold short is still open. It has moved back in the right direction, and I've adjusted the stop loss conservatively below entry price. I'll likely close it this coming week. With another strong down day, I may be able to cover my direct losses from all the prior stops with just this one position. We'll see. Either way, I'll be watching for the rebound to exit. These experiences remind me that real learning only happens through doing and adjusting. Each trade teaches me something new, and each insight gets me closer to becoming the investor I want to be. In our next newsletter, I'll share more about how I'm refining my shorting strategy and how I'm applying these lessons to longer-term positioning. Investor Skills Corner. This issue's deep dive ideas, hedging, shorting, and leverage. Hedging. A hedge is like buying peace of mind. It's not meant to make money. It's meant to reduce the damage when things go wrong. The key is knowing how much of your portfolio you want to protect. Let's say you have a $100,000 portfolio and you want to hedge 20% of it. You calculate the dollar risk, for example. A 10% drop equals $2,000 risk on that portion. And then choose an instrument, like a long-dated put or inverse ETF, that will increase by that amount if the market drops. Hedging isn't about timing perfectly. It's about limiting downside without taking yourself out of the game. Shorting. Shorting is betting on prices falling, but more than that, it's a mindset shift. Most investors are wired to think up equals good, down equals bad, but down markets create just as much opportunity as up markets if you're prepared. Shorting is not inherently riskier. The risk comes when using leverage, poor timing, or ignoring stop losses. Managed well, it can be a core skill that balances your portfolio through any cycle. Leverage. Leverage is simply using borrowed money to increase exposure. It magnifies both gains and losses. Used cautiously, it can accelerate results. Used recklessly, it can destroy portfolios. The key is knowing your downside and having exit plans before you enter. The goal isn't to avoid leverage completely, it's to use it wisely in proportion to your confidence, skill level, and risk tolerance. Final thoughts. This month reminded me why we invest, not just for return, but for resilience. Whether through options hedging or shorting, the ability to respond rather than react can change everything. So here's my question for you. How are you navigating the uncertainty? Are you sitting in cash, riding the waves, or practicing new strategies? Hit reply and let me know. I'd love to hear what you're trying, what you're learning, and where you're growing. For information on what we're doing in the community, check the written version of the newsletter. Until next time, stay curious and keep building your financial confidence.